Assalamualaikum. We are from Group 2 and we will be presenting about the factors that influence exchange rate. So I am the first presenter. My name is Amira Shafina and I will be presenting about the economic factors. So exchange rates are influenced by factors such as economic performance, political stability, market demand, global trends, and central bank policies. These elements interact to shape currency values, impacting trade and international finance. Economic factors play a crucial role in influencing exchange rates. Higher interest rates attract foreign investors seeking better returns, leading to currency appreciation. Similarly, countries with lower inflation maintain stronger currencies as their purchasing power remains stable over time. Robust economic growth also strengthens a currency by drawing in foreign investment. A surplus in the current account where exports exceeds imports boosts currency value, while a deficit has the opposite effect. Conversely, high levels of government debt can deter foreign investors, causing a currency to weaken. These factors collectively determine a currency's relative strength in the global markets. That's all from me. I will pass to the next presenter.
Hi everyone, my name is CD and I will be presenting about the market-driven factor for our assignment. So for the first one, we have the supply and demand dynamic. The trade rate of money is fundamentally decided by the supply and request for it within the remote trade advice. So what I want to explain about that part is that importers need foreign currency to trade goods and services. For example, if Malaysia want to trade from USA, they will need USD dollar. Therefore, they will be increasing the demand of USD. For the second one, we have the interest rate differential. The high entry rate in a nation pull in remote capital, expanding requests for its cash and driving up its team. So what I want to explain about that part is that investors are always seeking for the best return on investment, the ROI. Therefore, if one country propose a higher interest rate than another, it will be more attractive. For the last one, we will have the trade balance. A nation with exchange overflow, which sent out is greater than the import, encounter higher request for its money. So it means that the trade balance is a key economic indicator that reflects the difference between a country export and import of goods and services. That will be all for me. I will pass to the next presenter.
Political factors are events or decisions relating to the government and stability of a country that can influence the exchange rates of currency. In general, investors prefer place their money in a stable country. When there is a political instability such as war or unrest, this creates an uncertainty and can depress the value of the currency. Elections are a good example for a political factor. Before an election, investors observe the candidates and their economic policies. If the election results uncertain, or if a candidate proposes risk change, this can cause the country currency to fluctuate. Government decisions such as tax and imports or sanctions against other countries also exert the exchange rates. For example, the trade war between the United States and China has created tensions that have impact to the currency of both countries. Finally, international relations and trade agreements can either strengthen or weaken a currency. Positive agreement can increase confidence and that value of the currency, while tensions or disagreements can have two opposites, etc. A clear example is the Brexit, which has caused significantly an instability for the sterling. Thank you.
The exchange rate, which represents the value of one currency against another, is influenced by several external factors. There are the main external factors affecting the exchange rate. Firstly, global economic factors such as international interest rates. When the US Federal Reserve FED raises interest rates, as in 2022, it attracts foreign investors to the dollar to take advantage for high yields. This references the dollar's value against other currencies, such as the euro. Fluctuating commodity prices, such as oil, also influence the exchange rate. When oil prices rise, exporting countries like Canada see their currency, the Canadian dollar strengthens. For example, in 2022, the rise in oil prices to the war in Ukraine supported the Canadian dollar. Thirdly, geopolitical events such as conflict also impact exchange rates. Following Russia's invasion of Ukraine in 2022, the Russian ruble fell due to economic sanctions imposed by Western countries, reducing demand for the Russian currency. In addition, the intervention of central banks through their monetary policy. The European Central Bank, ECB, raised interest rates in 2023 to counter inflation, strengthening the value of the euro against the dollar. And then the market sentiment has loss of confidence during the Brexit vote in 2016. Investors lost confidence in the UK's economic stability, leading to a fall in sterling against the US dollar. Finally, exogenous shocks such as pandemics influence exchange rate. During the COVID-19 pandemics, the US dollar strengthened because it is perceived as a safe haven currency, while currencies of emerging countries such as the Mexican pesos lost value.
Hi, my name is Khadija Hanim, and I'm going to explain central bank policies as the factor that influence exchange rate. So, central banks are key players in the global economy, and their decisions significantly impact exchange rates, the value of one currency compared to another. One of the primary tools they use to influence exchange rates is monetary policy, which includes actions like adjusting interest rates and implementing quantitative easing. Quantitative easing is another tool used by central banks, particularly during economic downturns. This involves the central bank purchasing government bonds and other financial assets to inject money into the economy. The goal is to lower interest rates and encourage lending the investment. While this can help stimulate the economic growth, it can also lead to concerns about inflation or currency devaluation if too much money is created. Overall, central banks aim to manage inflation, keeping prices stable, and ensure their currencies remain stable as well. When investors trust that a central bank will effectively manage the economy, they are more likely to invest in that country's assets, further supporting the strength of its currency. So in conclusion, overall the factors influencing exchange rates are complex and interrelated, encompassing economic indicators, political stability, market dynamics, and external influences, and central bank policies. Understanding these factors is crucial for anyone involved in international trade or investment, as they significantly affect the value of currencies in the global stage. By analyzing these elements, stakeholders can make informed decisions that align with their financial goal and risk tolerance. And that's it from our group. Thank you.